Imagine checking your investment portfolio and seeing a return of 2,600% in just 12 months. That actually happened in 1999 to investors who bought shares of a company called Qualcomm. Most people assume the dot-com bubble burst because the internet was just a useless fad. But the truth is the exact opposite. The internet did change the world completely, just like everyone predicted it would. The disaster happened because investors assumed the future would arrive overnight and paid insane prices for businesses that made absolutely zero money. What most people don't know is that we are watching the exact same psychological trap play out right now in the stock market. To understand why billions of dollars could vanish from the market very soon, we have to look at how the original tech bubble started. In the late 1990s, the World Wide Web became accessible to the public, and it triggered an absolute gold rush. Capital flowed into anything ending in .com. Companies saw their stock prices double or triple in a single day simply by announcing they were launching a website. Traditional ways of measuring a company value, like actual revenue or profit margins, were completely ignored. Investors started using new made-up metrics like search traffic and consumer eyeballs to justify these wild valuations. The mindset was get big fast or get lost, and profit was considered an afterthought. This allowed a company called Pets.com to go public and reach a massive valuation without ever making a penny in profit. They spent millions on Super Bowl commercials while losing money on every single dog food delivery. Before you skip to the end of this historical lesson, look at how closely this matches today. The madness reached its absolute peak on March 10th, the year 2000, when the NASDAQ index touched an astronomical high. Tech stocks traded at over 200 times their actual earnings. For comparison, the historical average for the stock market is closer to 15 times earnings. Another shocking example was a business called Internet Capital Group. They invested in other online startups and saw their market value skyrocket to $60 billion. The founders became paper billionaires overnight despite the company having virtually no real revenue. Then the Federal Reserve raised interest rates slightly to cool down the overheated economy. That minor policy shift triggered a massive wave of panic selling. Within months, the NASDAQ plunged by nearly 80% and wiped out $5 trillion in wealth. Internet Capital Group crashed from $60 billion to just a few hundred million. Even massive, profitable giants like Cisco lost 80% of their value. The surprising part comes next because this exact cycle is repeating with artificial intelligence. If you are finding this financial breakdown valuable, hit that subscribe button right now so you never miss our deep dives into global market trends. Now let us fast forward to our current financial reality. History shows us that human psychology does not change and greed always takes over when groundbreaking technology emerges. Right now, artificial intelligence is drawing identical comparisons to the early days of the internet. The market concentration we see today is actually higher than it was during the peak of the dot-com era. Today, just 5 massive technology companies hold up 30% of the entire S&P 500 index. That is the highest concentration of market value in half a century. Investors are piling into AI stocks at a record pace because they believe it will transform every industry on Earth. The Shiller price-to-earnings ratio for the broad market has officially crossed 40 for the first time since the dot-com crash. This metric proves that stocks are incredibly expensive relative to their historical earnings power. What most people don't know is that legendary investors are already sounding the alarm. Michael Burry, who famously predicted the 2008 housing crash, warned that current conditions resemble the final months of the dot-com bubble. The most dangerous similarity between then and now is the massive gap between company valuations and the actual revenue they generate. Look at OpenAI, which is currently valued at a staggering $730 billion in private markets. To put that in perspective, they are generating roughly $13 billion in annualized revenue. That means their valuation is over 50 times their revenue. Even worse, the company projects cumulative operating losses of $140 billion through the year 2029. They are burning through $15 million every single day just to run their video models. Another major player, Anthropic, has reached a valuation of $380 billion, while generating tiny fractions of that in real sales. These startups are valued like highly profitable empires when they are actually burning cash at an unprecedented rate. Big tech companies are projected to spend a collective $700 billion on AI data centers this year alone. But current enterprise spending on AI software is only a fraction of that massive investment. The surprising part comes next when we look at the cracks forming in the foundation. We have already seen a terrifying preview of how fast this AI bubble can pop. A single press release from a Chinese startup called DeepSeek proved how fragile these high valuations really are. They released an advanced AI model that cost just $5.6 million to train. This shocked investors who assumed that companies needed hundreds of billions of dollars in hardware to build powerful AI. In a single day of trading, Nvidia lost $588 billion in market value. That was the largest single-day loss for any individual stock in financial history. It proved that when the optimistic narrative shifts, the sell-off is instant and violent. When a market is built entirely on high expectations, any sign of slowing growth or cheaper competition causes immediate panic. Actionable insight for smart investors today is simple. Do not buy stocks based entirely on hype or future promises. Always look at free cash flow and real corporate profits instead of raw stock momentum. The market could continue to climb, but history proves that gravity always wins in the end. To protect your capital, you need to understand exactly what happened to the markets today. Watch our next video breaking down the sudden shifts in global tech stock data right now. This content is for educational purposes only, not financial advice. Always do your own research before making any investment decision.